can we continue to command such high valuations when uncertainty is higher than it's ever been?
Right.
And I think the president really enjoys having uncertainty. Like,
Right.
I think he likes having that control. So I think that's why, like, almost in a way, the market biases towards hope this year.
Yeah.
Like, hope, like, I still think that the tariffs are going to be fine. Hope that the Treasury, that rates are going to be lower, that the Fed is going to cut, and that it all ends up being fine and the market can look through it. And I think in some ways that's right if you're like a long-term investor, but if you're kind of trading day to day, I think this is a really hard market.
Welcome to the Risk Reversal Podcast. I'm Dan Nathan. I'm joined again by Stephanie Guild. She is the CIO at Robinhood. Steph, welcome back to the podcast.
Thank you. Thanks for having me again.
All right, you haven't been, I can't believe this. This is the first time in 2025. Does that sound right?
Yeah.
You joined us a couple times in 2024. I've seen you on CNBC a bunch. You do a lot of media and you're great at it. We appreciate you being here. It's Friday morning. It's just before the opening. We had the market close yesterday for Juneteenth, and we did have the Fed meeting Wednesday afternoon.
Right.
Kind of a weird setup.
Yeah.
So you and I, we're going to talk a little bit about Fed, what you took away from it, some of your thoughts about, basically, monetary policy for the balance of the year, maybe headed into next year. We'll talk tariffs. We'll talk tax. We'll talk, is there something else with the T I can throw in there? And then transitory maybe. How's that? See, transitory.
Inflation.
So we're going to hit the three T's.
Yep.
We'll talk a little bit about tech disruption. And I think the company that you work for, I think you guys have been at the forefront of some interesting stuff on the tech front and financial services. So we'll talk a little bit about that. And then hopefully we'll get to what your customers are doing and thinking. I know that you have a good beat on that.
Yeah. Yeah. Sounds like a full agenda.
We got a lot to do. We have a really important guest in the studio. His name is Griffin. He's your son who is 8 years old, and he is helping Bill run this fine podcast. So thank you, Griffin. All right, let's do it. You're sitting there like everybody else. You see the obviously what comes out from the Fed at 2 o'clock. Then they have the presser. It goes from 2:30 to 3:15 or something like that. Markets usually move around a little bit. I guess the messaging out of the gate was not anything that people were surprised by.
Right. So market went up.
Yeah, it went up and then went down, and then it closed dead flat on the day. One quick take I had was that obviously there's a lot of investors. Most investors really do want the Fed to get a bit easier, right?
Everybody, and including our president.
Right, including the president. But also it seemed to me that a lot of the questioning by the press pool to Fed Chair Powell, they were like beating the same drum. Like, when are you going to lower? Why do you stay put? You know what I mean? With this, So let's talk a little bit about what you heard, how you kind of come out thinking about it.
I went into it thinking there's no way he's going to lower rates. Or raise them. There's no way he's going to say that anytime soon he's going to. Because there's way too many things that are up in the air. And that's exactly what he said. He said there's too much uncertainty. And then he did point to tariffs and said, I think specifically the quote was, tariffs are going to raise prices. Someone's going to have to pay them. Some of it is going to end up in the consumer. We have to see how that goes. And I feel that there was this drumbeat leading up to it because a little bit of volatile data, like some of the housing data has gotten better. That's great. But then the weekly claims.
And retail sales.
Sales, although if you looked at the control, it wasn't so bad. And most of the retail sales were lower because of energy, because oil prices and gas prices were down. So I think it was just a lot of hope. And I think the market was trying to tell the Fed what to do. And Powell has been very I don't care. I don't care about any of that noise outside.
Right.
And I was a little bit, I think also the op-ed from, it was just, it's from someone who wants the job
Waller,
as Fed. I just think it was just this train of the market trying to tell the Fed what to do, and they should know.
Yeah, I mean, the fact that the market was unchanged, the fact that the market has been rallying into it, the fact that the market rallied S&P 25% for 2 years when, Fed funds rate started out in 2 years ago at 5.5%. Last year it ended at 4.5%. Right. The markets have not minded for the most part, higher Fed funds rates, even though we've seen a 10-year yield that's basically been flat here around 4.4-ish or something like that.
I don't think it can get really lower from here.
Unless you start seeing, a more dovish tone, right? And so the one thing, all right. So
I think we had to separate the 10-year from the 2-year and the short end of the curve.
But so let's think about this for a second, right? So you just mentioned Waller. He's writing this op-ed. He's basically saying the Fed should cut by 100 basis points. He's speaking to the president, like, for all intents and purposes, the audience of one.
Used one data point that's very volatile, by the way.
Yeah, but I mean, listen, going back to your point, there's a lot of folks, investors, who want to see cuts. Fed Chair Powell, I think, worries that inflation is going higher because of the trade and because of geopolitics. He also lowered GDP outlook too. So talk about that is like, okay, worried about inflation, lowering growth estimates,
increased
and that speaks
unemployment
to,
by a touch.
That's right. It speaks to stagflation.
Yeah, I mean, they're worried about all the things that, like, I'm sitting here and watching and worrying about, and I think they're willing to look through any sort of near-term benefit that maybe had come from, because if you look at it, like, CPI is better because of energy and oil, and now the issues that we're having in the Middle East and the conflict there is putting pressure on that again. So I just think, like, he's just a patient guy. I do think in hindsight he should have kept cutting a little more when things were improving before we had all this other stuff.
Right.
But now if I were him, I would.
Well, think about this. He did that 50 basis point cut in September. At the time, they talked about, like, the jobs market. They talked about unemployment possibly, moving higher, and that worried them a little bit. I don't think they were so bullish as far as growth was concerned. This is late last year, and now here we are. To your point, like, we're in the middle of a bunch of stuff. Like a potential war or protracted war, right, with Iran, and there's a whole bunch of implications as it relates to oil. We obviously have, a protracted trade war that could, kind of get worse than I think we're looking at this right now. A lot of people feel pretty comfortable about where we are. I want to speak to a little bit about expectations for S&P earnings, because that's how we will think about all of this, right, as it relates to the markets. Where are you right now? Coming into the year, I think the expectations or consensus was for 13.5% year-over-year earnings growth. That's come down a bit. Your numbers are well below that. Let's talk about it.
Yeah, so they were 13%, like you said. They've dropped to around 9%, and it happened in the first quarter for most of it. And then so that 13% for 2026 now is off a lower base, but hasn't really moved. I think when you look at it, so my view is that there's kind of a rule of thumb of every 1% drop in GDP, you have a 4% move in earnings growth. And we don't know what the drop in GDP is going to be. I know we had a Q1 that wasn't so great, but a lot of that was, like, I think just
pull forward.
It was just a lot of stuff, importing stuff in advance of tariffs. So that hurts GDP in the short term. But if that's true, then I think probably it should drop a little bit more to like the 7-8%. My view is 7% earnings growth for this year, and for next year more like around 9%. So for me, and I'm applying a generous multiple to that, right? So the multiple now is close to 22 times. Again, I was sort of applying that 21, 22 times, and then I got to 6,200 if I kind of look forward over the next 12 months, not just, earnings for 2025. That's what my target has been for a little while. I moved it down from 6,500 at the start of the year.
Which was kind of consensus, right? Wasn't it?
It was at the low end. If you remember, there was like some 7,000, I don't know what they've done with them since, but I was sort of on the low end of the range. And I know some people have moved down dramatically. There is a chance, though, because I think it's this kind of environment where you can't just be like, this is my one target. Like, I think to be like, if this, then that. And my other if this, then that is if tariffs end up being higher than, say, like 10% on average, in the places that count, then I think it ends up being, it should probably be a lower S&P. Like, I think that's where I kind of see 5,800. All
right, let's talk about RBC Capital, because they're kind of doing a lot of different math right here. But directionally, you guys are in the same place, and I'm only bringing this up because I think that they have taken their S&P 500 earnings for this year down to $258. Consensus about 265, right? So to your point, at 265 with the 6,000 S&P, you're getting about 22 and a half times, which is rich if you're just looking at FactSet's data over the last 5 and 10 years. It's probably one or two turns, you know what I mean, richer than the average.
Long-term 10-year, excluding that 2020 period, is 19 times for the S&P.
Okay, so pretty rich. And so on 258, you're talking about a little over 23 times. So it doesn't leave a ton of room. If you have a growth scare, you're going to have the S&P is it going to go back to 48.50 where we were in the first week of April? Probably not, but you could definitely see something that looks like 5,600 or something like that. We were 5,700 when the taco trade was really confirmed, like when Trump pushed out the China tariffs.
Yeah.
And pretty quickly we're going to be coming on that July 9th date, right?
I know.
And so like one of the things I think is interesting is like you just said, there's a lot of moving parts. There's GDP, right? There's interest rates. There's obviously tariff rates are going to be really important. So
the deficit.
Yeah, well, the debt and deficit, and what happens to spending with the tax bill, because the cuts are going to be retroactive, okay, as far as tax rates, but the spending's going to stay for a while, which is stimulative. Right. So let's break that down for a second, because I think the outlook is as clear as mud. And if you're thinking that tariff rates stay, let's say, above 10%, I mean, coming into the year they were 2.5%. So
I mean, it's going to hurt. I think it's going to hurt growth.
Yeah.
And the question is, like, does it hurt inflation more than it hurts growth, or vice versa, right? And I think, I was on CNBC the other day, and someone had said, we think the net outcome is hurts growth more than it hurts inflation. But I think in the short term, it's inflation more than growth. Yeah. Like, I think it just takes time to kind of work itself out, and then it stops being inflationary and just starts being almost deflationary in the long term.
Because people pull away from buying.
Exactly. Yeah. So and if you look back in history, the times that we had it, that was the case, but we haven't really had it in modern times. So I don't know if you can use that. Then you've got, like, obviously oil, right? Where there's the stuff that's happening in the Middle East now, and the geopolitical tensions are impacting prices and moving them higher, which takes inflation higher. Which should slow growth. But then you have, on the other side, OPEC is increasing supply.
And there's an OPEC Plus meeting first week of July.
So I do think that there's been some good relationships established there, at least recently. It seems like that on the surface. So maybe those two things net each other out.
Yeah.
Then you have the deficit, and like you said, I think you can end up being stimulative. You have the SLR thing that went into place earlier this week, right? Which increases the amount of buying that a bank can do of treasuries.
Right, and the banks liked it. So like all the bank stocks, major money centers were up 2-3%. Wells Fargo outperformed because they've had a lot of curbs on them, that sort of thing.
Regional banks did
but let me ask you this really quickly on that. Do you think that has something to do, this perception that there's a lack of buyers of U.S. treasuries right now, so you give the banks the opportunity to kind of participate more in that market?
I think they need everyone they can, right? So like it's the same thing. And they said, that's why I think, like, if you're thinking about this deficit too, like, there's probably less buyers. You've seen the amount of central banks buying gold, right? Ever since Russia-Ukraine happened, the amount of gold buying has increased by central banks versus treasuries, where that's what it used to be.
Right. And we were our friend Peter Bookvar, my friend from Bleakley Advisors, he had a note out this morning in the book report suggesting that last month the Canadians, who obviously are not particularly happy with the United States, or at least our White House right now, sold 13.5% of their U.S. Treasury holdings in 1 month. Now, Peter went on to say it could be some odd adjustment or this or whatever. But, like, where other countries who have not done trade deals, which is like 98% of them that we put these tariffs on, they have leverage. You know what I mean? So let's talk a little bit about that as far as that kind of sell America trade. Yeah. Selling U.S. Treasuries, which is kind of keeping our yields at this 4.43% in the 10-year. And again, we could look at the curve. Yeah. But also, we're selling dollars. We've had a bump in the dollar over the last week or so. How do you factor that in? Because, the Chinese, the Japanese, the EU, these are all large holders of our treasuries. They have the ability to kind of threaten selling dollars and treasuries.
Yeah. I mean, China's not number one anymore. No, Japan is, and I think followed by the UK. Foreign governments own about a quarter of our treasuries, outstanding treasuries. Right. And so I think one thing I think is, like, making me nervous out of all this, like, I think some of it could be hearsay, because at the end of the day, the dollar is still, like,
the reserve
clearing
currency.
reserve currency. And it's not just treasuries, it's like all different kinds of deals. But if that changes, that's when I get nervous. But if you're looking, like, typically the 10-year yield follows the dollar. Mm-hmm. And for the first time ever, like, if you looked at the chart, it's just like broken.
Right.
And that to me is saying something. And how do you interpret that? Like, I think it means that the yield might need to go higher, right? Like the market might be saying, the currency market might be saying, like, this dollar, in order for us to value you more, you're going to have to pay more.
Yeah.
And if you look, the amount of debt that we have, I mean, it's not slowing down.
Right.
Our interest payments are 3% of GDP.
But that's why, the president wants this tax bill on his desk by July 4th, and we're not far away from that. And his whole party, this is where the debate is. We know where the Dems are. They don't like it. They don't want to cut Medicaid. They don't want to cut a lot of this sort of stuff, but they don't have a say in this. And then you have these deficit hawks, in the Republican Party. They don't like what they see. They see a whole heck of a lot more spending. They see a couple $1 trillion thrown onto that debt over the next 5-10 years or something like that. So it'll be interesting to see how this plays out, because this is not the sort of thing that he can just strong arm through a certain part of his caucus, because we've seen this before. You know what I mean? And I don't know. So do you think there's going to be a back and forth as far as the tax thing? I've been of the view, first Trump administration, they went after tax cuts.
Yeah.
They got them. It gave a tailwind to the economy. It gave a tailwind to the markets. And then they dealt with trade. So I'm just curious, does both of these things have the potential to really mire the economic agenda of the president?
Yes, for sure. I think the thing that he had, right? So there's a three-legged stool they always talked about, right? Which is cutting taxes, it's deregulation, and then it's for tariffs, right?
Yep.
So the other two things, it's cutting taxes and deregulation. I think the cutting taxes is going to be really, really hard to do. First, corporate taxes are pretty low, especially versus around the world. We're kind of right in the middle of it. I think it's going to be hard to get them a lot lower. And then the things that they want to cut, Doge didn't do very much.
Yeah.
It's all just little drops in the bucket. And I can get on a soapbox about this forever, but we need to deal with Social Security.
Yeah.
And Medicare and Medicaid. I know the Senate cut Medicare more when they sent it back, the bill back, right, to the House. And that all feels awful because, some of the assessments have been that the least economically, well-endowed person gets the short end of the stick. Yeah. But I think there's a world in which we can reimagine it and spend less, because otherwise I think we're going to be stuck with higher rates, no matter what we do on the 10-year, right?
Yeah.
The 2-year, the Fed can control it. There's lots of things you can do, but on the 10-year side, I think that has implications for valuations. It has implications for mortgage rates. It has implications for corporate borrowing.
Yeah.
And that's why I get nervous about the economy, longer term. Do I think it's all going to break today? No. I think they'll figure out a way, and they'll promise cuts 10 years from now that never materialize.
Yeah.
That's it.
No, and I agree. And it goes, think about it this way, administration, you have a Republican, you have a Democrat, you have a Republican. At the end of the day, no one really wants to be on the line for kind of fixing those kind of long-term things that have been a big part of our deficit spending, if you will. No, I get all that. All right, let's kind of get to just geopolitics. What is your general sense? You've been in the markets for a while. You've been a strategist for a while. You've seen some of these dust-ups here and there. Generally, do you smooth them out? Do you kind of look at a period like right now where there's all this uncertainty? Are we going to get involved with Iran? Are we not? It's almost impossible to know what those unknowns are and what that means for the markets and the economy and oil and all that sort of stuff. So generally, do you look at this and say, all right, the president gave us 2 weeks that within that period, he might decide what we're going to do or not? Does the market doesn't seem to mind? The market just opened. This is Friday morning. We have an S&P that's up 40 basis points. People don't care. You know what I mean? If we start dropping bombs, these bunker busters or whatever, does the market just go back and make new highs?
Yeah, so if you go back in history, it matters for a 3 to 6 month period, and then it tends to stop mattering. So I think it's out of the last 80 years, there's been 36 geopolitical dust-ups, like you said, or worse, and 35 of those times it didn't matter. The one time it did, it was the Arab-Israeli War in the 70s. We had just gone off the gold standard. Yeah. We didn't have as much oil as we do today ourselves. There was a lot of other things at play.
Basically. You could try to draw comparisons, but it's not.
I don't see it being the same. So I think eventually, the market ignores it and goes back to earnings. Yeah. And what are earnings growth? And in the environment that we're in. I think the hard part is that can we continue to command such high valuations when uncertainty is higher than it's ever been?
Right.
And I think the president really enjoys having uncertainty. Right. I think he likes having that control. So I think that's why, almost in a way, the market I think the market bias is towards hope this year.
Yeah.
Hope, I still think that the tariffs are going to be fine. Hope that the Treasury, that rates are going to be lower, that the Fed is going to cut. Hope that this thing turns out to be nothing and it ends quickly. Not nothing from a human perspective,
right.
but and that it all ends up being fine and the market can look through it. And I think in some ways that's right if you're like a long-term investor, but if you're kind of trading day to day, I think this is a really hard market. Like, I think it's just chopping sideways, and we may not be able to command the premiums that we.
Well, that's the point. I mean, like, let's just do some math here, right? So if S&P earnings, let's say they get down to like low-ish single digits or 5%, something like that.
I mean, the long-term average is 6.
Yeah. And we're trading at, let's say, 23 times like 4% EPS growth, right? And then you made this great point about 2026. It's going to be, let's say, double digits, but off a lower base, and that's likely to come down too, especially if we have higher tariffs and we have lower growth and we have a lot of uncertainty and all that sort of stuff. Then all of a sudden you're looking at S&P that's 23 times. Now you could say is very top heavy. Some of the largest names, you know what I mean? And they're associated with AI. They have better than expected growth relative to the rest of the market, and they have much higher multiples. So when you think about that, are there some opportunities as you get away from mega cap tech?
Oh yeah. I mean, for a while I've been like, there's more to life than the Mag7. That's like been my thing. And I think we're in a stock picker's market, which is why I'm like, I don't know what's happening. I don't know what's going to happen.
Yeah, the macro's hard. Yeah.
The macro is way harder. I think the macro used to be easier and stock picking was harder. And that's why you just needed to buy index funds. And I think it's switched now. Because you have one other stat that I love to pull up is that the Fed did a study, and from 1989 to 2019, 42% of corporate profits came from lower taxes and lower interest rates.
Oh, wow.
And so if you don't have those two things, like now it's like, what is company management doing? Like, what is AI doing? AI will be deflationary longer term, but I think there's this. I just think now you'll get paid to focus on individual names.
So by the way, that's a really interesting point, because if you look at the Mag7, which has driven a lot of the performance over the last, call it 2.5 years in the S&P 500, it's obviously been a really huge contributor to S&P 500 earnings. Those companies who have huge cash balances, they're doing okay with Fed funds at 4.5%, and they actually have all of the capability to kind of negotiate however they do this sort of stuff,
so much
lower
power.
tax rates. So for them, this has actually been a really good sweet spot. It's also given them the opportunity to spend tens of billions on CapEx as it relates to, even though, because they don't have a hard time borrowing.
Or they don't even really need to.
Right? Yeah. So all right. So Mag7, you don't really care.
I mean, I think there'll be times to.
I don't mean you don't care. There's opportunities away from Mag7.
Yes, and I look, year to date they're down, right, and then the other 493 are up. Not a huge amount, but some, right? So that's why I say there's other opportunities.
Yeah, the S&P's up about 2%. The NASDAQ's up a little more than 4% right now. It's interesting in the Mag7, 4 of those 7 are down on the year. Right. Apple and Tesla are down about 20%. And then you have Amazon and Google down. Google's down 8%, and Amazon's down a few percent. So there has to be some other things that are working. Semis have come back, and that's a really important one.
Semis have come back. I think there's also, owning international this year.
Okay.
Right? Relative to the S&P, it just has been doing better.
Right.
If you look at, I think, year to date, I've got Euro Stocks 50, right? They're up over 20%.
Right, but you also have this dollar weakness. I mean, this is something that unhedged, you know what I mean, is a bit of a problem, right?
Right. I mean, but I'm saying is you also didn't need to care about any other investing outside the U.S. for a long time.
So what does that say to you? Because we launched this trade war coming at our allies first. So our biggest trading partners are Canada, Mexico, EU. All of their stock markets have massively outperformed ours, and they have not come to the table to do a deal for all intents and purposes. The EU's talking a little bit.
I think Japan really wants it.
Japan
they
wants
need
it.
Yeah.
So I just think that's interesting, because you keep hearing about there's other places to be other than the U.S. And the Mag7, and I think at least for the first half of the year, that is playing out a little bit. When you think about your user, the Robinhood user, and one of the things, and Guy and I have talked about this a couple times on the pod, when we were down at the Hood Summit late last year, we met dozens of your more active, let's say, traders, if you will, but then there was also, we were surprised at how many folks were really investors, not focused on the day-to-day. So it was really interesting for us to see a very wide range of user there, and we were really also impressed at the level of sophistication that a lot of them have. And I know that options has been a big driver, but also crypto on your platform. Yeah. And there seemed to be a lot of diversification, which kind of speaks to the way you're managing portfolios a little bit. So have there been a move away by your users from this obsession with Mag7 that most of the market participants have had over the last few years?
Yes, for sure. Like so there's two things that you always see. One is that they hold core positions, and that still includes Mag7.
Yeah.
And that might just be like, they've made so much money over the years. Like, why are they going to go take the tax bill this year? But whenever they go down, they tend to add a little more. And whenever they go up a lot, they tend to trim it. So, for example, like you saw Tesla as an opportunity when it sold off, right? When Trump and Elon got into an argument, and then they made up, and then the stock, like that's
regained.
So you saw them like buying into that and then selling into that. So the last week, like Tesla and Palantir were the place that got trimmed.
Yeah.
And then Apple got bought because it's also been kind of like not flourishing.
Not accurate.
But then you've seen in moments like when we had a couple of different names report earnings, they in the tech space, in the more like software tech space, they had good earnings, but this kind of market has been like, if you have one tiny little flaw, you get sold off.
Yep.
And so some of these companies they were buying into, looking for those opportunities.
What about IPOs? There's been a lot of talk about the IPO market coming back. Two of the biggest ones that we've had this year. First one was CoreWeave, very much in the sort of generative AI trade. They're a data center company, and Microsoft's a huge customer of theirs. And that stock went public at $38. I think right now it's trading at $175. That's just in a few months. It's got an $80 billion market cap, which is truly astounding. It's trading at crazy valuation levels. They have a ton of debt. They've already raised debt since they went public. Okay, and then you have this Circle, which is a crypto exchange, and that thing has been off to the races. This kind of went public just a couple weeks ago. When I look at these two names, it tells me something. It tells me that investors or traders, they want new issues. They want new stories. They want different ways or new ways to express certain views, and they're not particularly that picky about valuation. And these stocks have literally become meme stocks just like that. What are you hearing? What are you seeing from your users as it relates to new issues? Because there's a bunch that want to come out this year, and they're just waiting for a more stable market environment, I guess.
I mean, our users definitely want IPOs. Like when we offer them. And those two names that you mentioned, we did offer to our customers in advance. And some people were able to get allocations. I think part of it is like, and when you say like they want new issues, they want new ways to express views, I think that's very right. And Jamie Dimon always talks about this, but like the amount of stocks that are, companies that are public versus not, like, because it's become so onerous to be public, but like more stay private. And so I think there's two things that we definitely get demand for. One is IPOs. And the second is, is there a way for people to get easy liquid access to pre-IPO companies using things like tokenization.
Right.
And it's something that like our CEO has talked about a lot and, put out an op-ed about it, and being able to not necessarily have, the accredited investor or a qualified purchaser type of, assets to be able to access them. So I think it's been certainly a high demand, but again, on my soapbox, I really think we need to, in this part of like deregulation and a focus on that whenever that comes, like I would love to see an ability for people to maybe not just get access to pre-IPO, but also like, let's encourage companies to go public again. Like, let's not make it like as hard and not worth it.
Well, it's fascinating. So when Google went public 20 years ago, it was 2004, it was August, the valuation was $23 billion. It closed that day at a $27 billion, we just talked about CoreWeave that has an $80 billion market cap. Like it's pretty astounding if you think about it. So the fact that some of these companies have just waited as long as they have, and a lot of it was market conditions, except that the market went up 25% a year for the last 2 years. So I don't know what they were waiting for. And I was saying this for the last 2 years. If you can't bring an IPO after a bear market, after you have these sorts of years, when are you going to do it?
I think like if there's so much, there is also a lot of dry powder out there still in the private equity markets. Like if you private credit, right? Like private equity is blown up, and then you have private credit that's blown up even more, and then you have like all this money from wealthy investors that are ready to just continue to fund you. If you don't have as many like things you have to do,
right?
I think that's.
I want to come back to Robinhood and how you guys are positioning yourself. You talked about Vlad in this op-ed that he wrote, but let's do that at the very end. So I just kind of want to put a button in the S&P 500. So you have a target of 6,200. The S&P is trading essentially at 6,000 right now. We're going into the second half of the year. Yeah. I think a lot of folks are just exhausted. I think that, that period from the highs in February, I think it was 19th, to the lows in early April,
which created an opportunity
all right,
in the short term.
And I kept on reading these things about retail investors. They didn't get shaken out, and they were buying the way down. So speak to that a little bit.
They were buying on the way down, and they were doing it much more in just broad market. Just like we talked about, like right now is a better time, I think, to be a stock picker and kind of look for your opportunities. But in moments like that, it becomes a time just to get in the market.
Right.
And so we saw, on average, our volumes are like 20% of notional volume for ETFs, for example. During that time period, it was 40%.
Wow.
Because people were just like, I just need to
get
invested.
So they got broad market exposure rather than taking the idiosyncratic risk of buying a stock. A lot of the Mag7 were down 30, 35%. Some were down more.
But 40% of the S&P is the Mag7, right? So, or the top 10. So I think you just get that immediate access.
All right. That's a great point. And the QQQ, the NASDAQ 100, you get 50% of that. Right. My view has always been, whether it was the bear market in 2022, I was of the belief that the leaders in the bull market into any bear market, you'll hear this all the time, that leadership changes on the way out. It was impossible because of the weightings, right? And so the QQQ, if you want exposure to the generative AI trade or the Mag7 or whatever, that's the way to do it. And then maybe you have a few Palantirs in the other,
I think that's what they do. Like, yes, they do absolutely jump in when the markets go down, and then after that, pick their spots. Yeah. And I think the other thing about AI that I think is most interesting is that I think we're starting to come out of the chip makers being the only place to play it. I think power generation, does an ExxonMobil or something like that end up being an AI play? Right. I think that's where that's most exciting to me. And if you look at CapEx, which I've done a deep dive on CapEx, you have, one thing we saw is that earnings expectations, we said, came down from 12% or 13% to 9%. But for the last few years, sales growth has been lower than CapEx growth, right? And this year looked like the first year it was kind of maybe going to be neutral, and then it flipped. And now it's, again, that difference is negative, meaning that there's expectation of more CapEx growth.
Right.
And if you look through the names of who's increasing their CapEx, it's all the large tech companies that need power. Yep. And then you have the deals that get announced.
They're all doing the nuclear deals. Yeah. And, I keep reading articles. There was one in the FT this morning about the power grid and, the CapEx build out, the data center build out. Do they have power to do these massive data centers?
That's going to be their biggest hindrance. Yeah. And it takes years to create nuclear power plants.
Yeah, they're talking 2030 or 2031 when a lot of that stuff comes online. All right, so 6,200. We're halfway through the year. Your customers took advantage of the downward volatility. Back half of the year, let's assume that things stay right here. Let's assume that, they get taxed. The trade stuff, tariffs stay right here. Let's say we're going to have a little bit of a slower growth sort of thing. Let's say the geopolitical stuff doesn't get that much worse. Do you find yourself, if we see a slight reacceleration in earnings growth for a whole host of reasons, because let's say, we're start to price in more than expected rate cuts. Do you see the market moving, to new highs and maybe maintaining
for
that?
sure. Okay. And that's why in our portfolios, we took off some of the defensive positioning. We have this mix of low vol and growth names, but then I was looking at it thinking there's a world in which cyclical stuff comes back. Yeah. There's a world in which everything turns out to be okay. Yeah. And rates actually get to come down. And that's where I'm I think you need to be prepared for that, even if you're not going into it yet. And that's why I say that's maybe when you play a mid-cap space. Yeah.
All right. So here, I'm just going to read through some of the sectors that are down, at least through the lens of ETFs. And so XLV, which is pharma, down on the year. Yeah. IBB, which is biotech, down on the year. Yeah. IYT, which is transports, down on the year. Consumer discretionary, down in the year. Retail, down in the year. XBI goes back to, that's biotech. And so then when you see the outperformers, metals and mining, that's up 17.5% in the year. Industrials are up 8.5% in the year. And I'm like, oh, utilities, there's your power trade up 7%. Staples, defensive, as along with utilities, also up on the year. Energy up on the year, the XLE, obviously crude USO. So it is interesting where you're seeing strength and where you're seeing weakness. And it still speaks to a consumer that's dealing with inflation, right? It's dealing with rates. It's dealing with what could be higher energy prices and the like.
A labor market that is fine for now, but you have started to see an increase in weekly claims. I'm not putting a lot of weight into it, but it's something you got to watch. Like I think if we get to 4.5% on unemployment, like that's
Microsoft today
they were cutting more jobs,
6,000 more. They'd already cut, let's say, 10,000. UPS, I want to say
that's
a couple weeks ago.
That's why I think AI ends up being deflationary.
Right. So the 20,000 jobs. We heard what Andrew Jassy said, Amazon CEO
You're fine
about
for now,
yes, and then Procter cut 7,000 jobs. Intel cut 10,000 jobs. It's kind of what we saw in 2022, but for different reasons.
Right. Totally different reasons.
Yeah. So you think deflationary, you think productivity goes up, you think that AI ends up being deflationary?
Well, yes. Although, we've been using AI internally at Robinhood for a while now. And I think, it's not perfect yet. It's certainly and I don't know, who knows?
Customer service, coding, that sort of
that's
stuff.
That's that's where we're using it, right? Like our engineers are like, oh, it's so fast to do a unit test. It used to take me hours. It's 10 minutes now. When we're thinking about new code, I think we're using it in customer service, and there can be some small flaws whenever you give it new information, but it eventually figures it out. I think where we've been starting also to use it, and we talked about this in March when we did our launch for Robinhood Strategies, is alongside that we have something called Cortex, which will actually you go into a particular stock and it gives you the why behind the what happened right there. And we want to apply more and more of that.
And that's all quantitative, basically.
It's basically just pulling in news articles and things like that and just saying this is what happened and why. And then if you want to click into it, you get more detail, but you can just get the TLDR. And we want to apply more stuff like that to help our customer base be faster about their analysis. But it's certainly not perfect yet.
Right, of course.
Yeah.
All right, so that's stuff that customers can use, analytics and the like, for themselves to kind of make their own trading investment decisions. But then you mentioned a couple times, you've kind of launched an asset management business, and that's happened here in 2025?
Yeah, March 27th.
And it's only accessible to Robinhood customers?
Yes.
Okay.
Yeah.
All right. So, and you're managing that. You're the CIO.
Yes. Our team and I are managing it. We have over $300 million in AUM already.
Wow.
It's been a couple of months. The portfolios are, so this is kind of goes along with my view that this is no longer a market that you just want to own broad-based indices. So we actually provide stock and ETF, the portfolios are stocks and ETFs mixed together, not just ETFs like a lot of other places that do this. We actively allocate the dollars. We're not trading it every day, but we're definitely especially in this environment, watching the market closely.
Is there crypto in there, or by any chance?
Not right now. Okay. We're working on adding some other asset classes down the road. And we also want to add something that gives you a snapshot of your portfolio. The other thing that we do that I'm probably most proud of is that we leave messages for you in app as if you're advisor. So markets moved, here's what happened. We just made a change. Here's why we made this change. Kind of giving you, and it's right there under your kind of spark line chart, leaving a message for you, and we record them. So we talk to you.
Oh, that's pretty cool. So what I'm getting here, and you just mentioned Vlad in this op-ed that he wrote, you just added, portfolios, asset management, and you're using technology to really kind of make your customer feel like they're at least involved in the process, that sort of thing.
We give you ways to customize the portfolio.
Yeah. So you go ahead.
I was going to say, and the fee, this is the thing that I know Vlad was also really excited about, is that our fee actually gets capped out. So for gold members, any dollar above $100,000 is 0%.
Oh, wow. Okay.
Yeah, we want to be as much as we can in terms of guiding people on their financial journey.
Right. And then obviously crypto and options are a big part of kind of what your more active customers are using. So I just think that's really interesting, because we haven't seen too many, and I know that everyone was calling you a fintech 5 years ago, that sort of thing. And now it looks like a proper financial institution with lots of different touch points for your customers. And we've seen this again and again. When you have a service which is just a trading app on your phone, and then you have this user base that is attracted to it. Maybe they're like, millennials and this and whatever. But as they start growing wealth, as they start going higher up the ladder in their own jobs, they need more things. You don't want them to leave because you don't have the products and services for them.
And we're seeing, the average age of our customer base was, several years ago was below 30, right? And now it's 35. Okay. And that's prime time for, you're right in the middle of your career. You're too busy to think about something. So maybe you want to give some money to somebody else to worry about.
Yeah.
You need some help in planning. You need some help in thinking about like your holistic. And how can we do it in a way that like absolutely leverages technology to the hilt to keep the cost super low?
Right.
And that's really like what our focus has been across the board.
Right. And that sort of nimbleness is the sort of thing that makes you increasingly competitive to some of these large incumbent financial institutions. They're going to be the last ones to kind of adopt this technology.
Yeah. Especially like if you think about how our fee is, right, for Robinhood strategies, like the more you invest, the more you pay, and on a dollar basis. And we were like, well, why does it have to be like that?
Right. Well, you're getting leverage out of those technology investments also, and you're able to pass it through to the customer. Right. And I think that demonstrates in your ability to kind of offer those interest rates to, savers and the like here. So, all right, listen, we covered a lot of ground. I listen, I find obviously your market insights really interesting, and you have a very different job than a lot of other strategists because you have access to data about a user base or an investor that is driving a lot of the activity in the markets right now, right? And I think that's really interesting, and obviously the platform that you guys have built.
We see our customers are really smart. We're excited to help them.
No, we're going to be back at the Hood Summit again this fall, guy myself. So we're really excited about that. So we'll do a bunch of stuff down there together like we did last year. So Steph Guild, really appreciate you being here.
Thank you.
Thanks.